Good morning, everyone. My name is Emily Drake. I'm a partner and advisor with Fairport and Luma Wealth. We all hope that you and your families are staying healthy and that you're finding ways to enjoy life in this unique environment. Welcome to our third virtual investment town hall. Based on feedback we've received from you, we've scheduled these webinars on a quarterly basis. Many of you provided questions in advance, and our investment leadership team have prepared a presentation addressing those, as well as other subjects that are top of mind with our clients. Similar to the July format, we're going to break the presentation up in 4 segments: what happened, where we are now in regards to policy, markets, and portfolios. Of course, we'll address the presidential election. And finally, what data points our team is focused on. All of you are muted for this call and your cameras are disabled. Should you have additional questions throughout the presentation, you can type them into the chat bar on your toolbar. I'll be checking those following each section and we'll answer as many as we can, time permitting. So with that, I have the pleasure of turning it over to our Chief Investment Officer, John Silvis.
Thank you, Emily. I guess before we get started, I just want to thank everybody that helped us put this together. Only as good as the team surrounds me. So I'd like to thank the marketing group and also the investment team for helping me get all this stuff together. It is a Herculean effort, to be honest. So let's go to the first slide. I'll get started here. So what's happened? I think we've been focusing on 3 themes over the last few months, and I think we'll talk about them again today. One is the economic recovery is well underway, and we got a lot of slides to talk about that and give you our opinion on how that looks. Second, I think we've entered a bull market, and I think the equity markets have the wind to their back a little bit, and we'll talk about some of the reasons why we think that. And then the last one is, I think as we head into 2021, I think there's a positive backdrop for the year coming up, and I put it in three buckets. One is I think we're going to have a presidential inauguration in January. It may not seem like that today, but we'll get through it, and we will have that. 2, I think there's more stimulus on the way in 2021, regardless of who the president is entering the year. I think we'll see more of that, and you may or may not like that, but that's good for the markets. And the third one is I think we're going to see a vaccine. I don't know how we're going to get there, what it's going to look like, but I think we're going to see a vaccine, and that's positive. And I think the market's already looking at that going forward. So those are kind of the 3 things we've been looking at, and we'll talk about all 3 of those today. I guess the first thing we'll start off is I took this picture about a month ago at the local Costco here in Strongsville, Ohio, and as former President Ford says, our long national nightmare is over. So if there's one takeaway that Emily and I want you guys to have today, is that 1, Costco has toilet paper and it's going to be okay. That's the biggest takeaway. So, again, going down the quote line, first slide here is as we see, we use this all the time. We call this the economic or the quilt chart. What a long, strange trip it's been over the last little more than 9 months now. To kind of give you a recap, if you go back and remember, we started the year off with about a 5% increase into the month of February. It's a little better than average, but again, started the year off at a pretty good pace. We saw a decline from February into March of about 35%, putting us into a bear market, putting us into a recession. We saw a bounce off of that low in March 23rd through September 2nd of about a little over 60% increase back to record highs. That's all in the first 8+ months. Then we saw a 10% correction in the month of September, or almost a 10% correction, pretty close to September 24th. And then just recently, we were, I think as of yesterday's close, less than 2% away from an all-time high again. So it's been quite the roller coaster ride. I think we see further upside as we get into the end of the year. We're entering the 4th quarter, which historically has been it has historically been the best quarter of the year. And although we do have a presidential election in the next 3 weeks, I think as we get through that, we'll see markets adjust to that, and we'll see the seasonality kick in. So just to kind of maybe take a step back and take a little bigger picture. So if you look at the year through September 30th, so 12 months ending September 30th, the S&P 500 index was up 15%. The ACWI, which is the All Country World Index, which is a global equity index, was up 11%. So although it's been a volatile ride over the last 12 months, it's still better than average returns on the equity markets. Kind of put it in perspective, the bonds had a similar roller coaster ride over the last 12 months, but again, as of September 30th, they ended up 6.8%. So again, not the easiest way to get there, but I think overall we've seen positive returns over the last 12 months, both on bonds and equities. So I guess the question we get a lot from clients is, how long will this all last? People are very skeptical, which, I think at the end of the day is usually a good sign when investors are skeptical. That usually means there's further upside in the market. But this is kind of a chart over going back to 1996 of the direction of the market. As you can see, we've seen several long upswings. We've seen some shorter downswings, and I think we saw that again this year. If you go back to 08 through 2020, we had a 400% increase in the equity markets. But we think we're at the beginning of what is a multi-year bull market. So we think we have a few more years to go. Doesn't mean we won't see corrections. Doesn't mean we won't have points where you want to capitulate. I think that's all common in equity markets as we go forward. But we remain overweight equities. We're comfortable in that position, and we'll talk a little bit about why we're there and what's our rationale going forward here. And we'll talk about the length of the markets and how that corresponds to the economy as well in a few minutes. But shorter term, as I mentioned earlier, we are entering historically the best quarter of the year. As you can see here, fourth quarters tend to be positive by about 3%. It's not so much the percentage; it just happens to be that it's the highest, has the highest positivity outcome of the 4 quarters. So I think we'll see fourth quarter again. And I actually looked this up. I think we were about 3% to the good. I know the market was down at least at the open this morning, so we'll see where that's at. But we started the quarter off on a positive note so far. So I'll pause there. I don't know, Emily, if we have any questions yet, or you have any questions, or we can move forward.
Sorry, I muted myself because we've got workers chopping down trees outside my house. No questions yet, John, so why don't we go ahead and talk about where we are now.
Okay, so we kind of broke this down into 3 groups in the economy, markets, and how that all relates to our portfolio. So I'll go through there. If we have questions, we'll pause along the way. So, as far as the economy goes, we're going to take a little deeper dive. And as I said earlier at the beginning, I think one of the themes we're focused on is the economic recovery is well underway, and we believe it has much further to go. So we'll talk a little bit about the length of the recovery and the economic expansions in a second. But as you look at the second quarter GDP, that was down 32%. I think we all remember those numbers. It was a pretty shocking number to see. It as the worst decline in GDP in a quarterly basis since probably the last 80 years, going back to the Depression. Worst in my lifetime. Hopefully will be the worst in my lifetime. But we do believe the economy bottomed probably in early summer, late spring, sometime that May, June timeframe. And we think we're going to see further upside. So this is as you can see in this chart here, this is something we use quite a bit. It's from the Atlanta Federal Reserve. It's called their GDP Now indicator or model, and it's been pretty accurate both on the up and down side of economic forecast. And it's forecasting a third quarter GDP growth, which ended in September 30th, of about 35%. And it sounds like a lot, and you may think, well, that's kind of an outlier, but it's not really. Goldman Sachs and both Evercore ISI both came out, and their forecast for the third quarter, again, and we'll get that preliminary number sometime at the end of this month, with both at 35%. So it's in line with consensus, and I think we're going to see at least growth of 25% or more in the third quarter, and it'll get revised a couple times. But I think more importantly, that strength has been carried over into the fourth quarter, and most estimates, although it's early in the fourth quarter, put us somewhere around 10% GDP growth in the fourth quarter. So the economy is definitely on track to recover, or on track on its recovery, I should say. So, we focus on a lot of some of the economic numbers that come out on a weekly basis, and sometimes people might think, well, that's kind of redundant because it's a lot of data and it comes out very quickly. But I think it's important because I think it's consistent. In fact, unemployment claims, which we've talked about a bunch, went from historically low at the beginning of the year, pre-pandemic, to I think an all-time high of almost 7 million. But we've seen that come down and it's kind of leveled off. So the question is there more stimulus on the way? Because most people at this bottom end who are continuing tend to be on the service end of the economy, the restaurants, retail workers, and I think there's a growing consensus that probably do more. So I think there's going to be more stimulus on the way. I know obviously politics and the presidential election is kind of getting in the way, but so just kind of give you a point in reference. The number comes out every Thursday morning at 8:30. So this morning it came out. It was actually closer to 900,000. So we're starting to see a little bit of an uptick, but I think we're well off the top. I think we've kind of leveled off here, and I think overall it's something we keep a pretty close eye on. Another weekly indicator we look at, and this kind of goes back to the shape of the recovery. And I know probably back in March or April when we had a town hall, we talked about, is it a V, is it a W, is it a Y, is it a Nike swoosh? I've heard the term, is it a K? I'm not even sure what a K is, to be honest with you, but it's starting to look more and more like it's a V-shaped recovery. So one of the ones, again, indicator we look at pretty closely is the Evercore ISI company surveys, and a couple reasons why. One, it comes out weekly. Two, it tends to lead GDP growth, and it's been pretty consistent in that over the last 20 years. And two, I think it's a real-time pulse of the economy and what corporations are thinking, not just politics or government agencies. It's really going right to the corporations. And as you can see here, you're seeing this V-shaped recovery. And I'm going to go through a bunch of slides here pretty quickly because they're all the same, but you're going to see a pattern that looks pretty similar to everybody else's. Again, here's the Empire State and Philly Fed Index. Again, you're seeing a pretty sharp reversal here. Looks like a V. Vehicle sales, which I don't know if anybody's tried to buy a new car or even buy a used car, but vehicle sales are pretty much on fire out there, maybe only rivaled by housing market. But so vehicle sales are averaging about 16 million on an annualized basis, which was off the bottom, which we saw during the pandemic of around 8. So it's double that. And long-term average is somewhere around 17. So we're pretty much right back to where we were. And again, I think that's a combination of one, probably pent-up demand, but two, also very low interest rates, which we'll touch on in a second. A couple more of these, and then we'll move on to a different subject. But globally, you're starting to see the same V-shaped recovery. So this is the global economic leading indicators out there. This is the September reading. We'll get an October reading here pretty soon. But as you can see, that V-shaped recovery is pretty pronounced. And I guess the other thing I'd like to say is, as good as the bounce back was here in the third quarter, China, even in Europe, they're starting to see very similar things. Canada, their job numbers almost back to where they were pre-pandemic. So again, you're starting to see not only domestic recovery, but it looks like it's going to be a global recovery as well. So what does all this mean? It means we're probably going to see a new high in GDP or gross domestic product sometime in 2021. And as you probably have heard me say over many times in the past, I think our thesis has always been that if the economy is growing, and we're starting to see signs that it's getting back to pre-pandemic growth, earnings tend to grow, corporate earnings grow, and if corporate earnings are growing, that's good for the markets, not only domestically but globally. So I think although that pattern had got thrown during the shutdown, I think we're starting to see that take place again. So I think as GDP grows, that's a good thing for corporations, and it's a good thing for markets going forward. I'm going to touch on this one real briefly, but consumer net worth is basically moving even higher, and it should be moving higher into 2021. That's just a combination of housing market, which people's house tends to be their biggest asset, and the housing market's on fire right now, and in the stock market. So as consumers feel confident about their assets, they tend to spend more money. So that's a pattern we're going to see continue. I would imagine most of our clients probably own a house, but if you don't own a house, it's a great time to buy one. 30-year mortgages through September actually broke below 3%, so 2.98%. And even millennials, believe it or not, are out there buying houses. So again, that's a great indication for the health of the economy. So I did talk a little bit about low rates, and one of the negative sides of this is just the return on cash is very low, and that's probably going to stay low, to be honest with you, because that's where interest rates are today. If you look at this blue line, this is the current yield curve. So anything from 10 years or in, so the 3-month, the 1 year, the 2 year, the 1 here, all the way up to 10 year is all under 1% return. In fact, money markets are yielding only just a few basis points, and that's just a function of the short term of the curve, which is the Fed fund rates is 0. So we're not going to see any probably increase in the short end of the curve, if you believe Chairman Powell, and I tend to take his word on this one, through at least next year, most likely into 2022. I've heard some people think that they won't raise rates till 2024. That's a pretty long forecast, but either way, I'd say the next 12 to 18 months, we're going to see rates on the short end of the curve stay pretty low, which will keep cash yields pretty low as well. I can pause here, Emily, or I can just go right into the markets if you want. Is there any?
No questions at this point, John. Go ahead.
Okay. All right. So, transitioning from the economy into the markets, I kind of tipped my hand a little bit. As I said, I think the economy leads earnings, and earnings lead the market. So, usually when you see an economic expansion, which we're in currently, that tends to go hand in hand with bull markets, and I think we're seeing that now. They don't always start and finish at the same time, but they tend to head in the same direction. So this is a chart put together by Evercore ISI and looks at the last 5 economic expansions, and they listed them here on the chart. But if you look at them, economic expansions on average last about 8 years. So I'll take the average and assume the current expansion we are in will probably last somewhere around 8 years, which is the average. And the returns can be anywhere from 100 to 400% on the S&P, but on average about 250%. So although we've had a pretty big move off the bottom, we've had a little bit of a correction, but we're not that far from all-time highs. I think history very well could repeat itself, and if we see a expansion of at least five years, but maybe closer to 8, which is the average, I think markets will move in tandem with that. A lot of talk about the 5 largest holdings in the S&P. I don't really have a big issue with it. I know it tends to be a headline grabber, but I think what we're seeing currently, and we'll talk about some of these trends in a second, is the market is starting to expand leadership. So you're starting to see other areas of the market outside those technology names start to show some leadership as well, and I think we'll see that continuing, which is why we think the market's broadening out here. And there's a couple of themes that I'm going to point out here in a second. First is I think the dollar weakness, and we've seen a move higher here off that March low. Really, that was just a flight to safety, I believe. We've seen it kind of go down, as it mentions here. We're having a little bit of a bounce, but I think there's some resistance around here. And why is that all that important? Well, normally 2 things. One, when the dollar tends to weaken, it tends to be good for equity markets. It tends to be better for equity markets. And 2, it tends to be better for international equities as it relates to U.S. investors as it translates back to dollars. So, we're starting to see a little bit of tailwind in emerging markets. They've been one of the better performers off the bottom in March. If the dollar continues to weaken, and we think it will roll over here probably after the election, then that should be a tailwind as well. The other one out there we talk a lot about, or we hear in the news media, is the growth versus value, and a lot of times it's like, well, we think there's going to be rotation into value. I don't really have an opinion on that necessarily. We tend to be leaning towards the growth side of things. you have seen this is basically valued relative to the S&P, and as you can see, it's been a pretty consistent decline. There was a little bit of a bounce coming in that drawdown in September, but since the markets have turned around, you start to see it revert back to its old trend, and I think it's going to probably break lower here. I think there's a couple things driving that, and this is why I look at more on the sector side of things. But technology tends to be the biggest position in growth names, or in the growth index, and technology is driving innovation. I don't think innovation is going to stop anytime soon. There's a big push towards moving to the cloud, moving to 5G, all these things that people are paying online now. People are shopping more online. So I think the technology tends to be a long-term secular leadership here. And then the biggest holding in value tends to be financials, and financials are struggling. And we've seen some of the banks come out with earnings recently. Just banks don't perform really well in very low rate environments like we are in today. And as I mentioned earlier with Chairman Powell, I don't think that's going to change anytime soon. So I can't say there won't be a rotation out of growth into value, but tell me what that catalyst is first, and I don't see that changing other than some of these relief rallies that we saw in September. So despite elevated valuations, and I say that by meaning the price to earning valuation. You hear a lot of people talk about the PE. The PE multiples are very high historically, which I don't necessarily dispute. I think equities still look attractive relative to treasuries, or even relative to bonds overall. And I think as you look at stocks versus bonds, we still think stocks are the better buy. And at historic lows, and again, going back to the theme that low rates will probably stay low for a while, we still think equities are attractive on that basis, which is again another reason why we've been overweight equities and slightly underweight fixed income in our models. We'd have to see either a move in rates where the Federal Reserve would come out and raise the Fed funds rates, or a really big higher move on multiples, higher than they are today, for us to be concerned and think that might be changing. And so far, we don't really see either one of those. So as far as earnings go, I mean, if you shift the outlook to earnings, so we talk about the economy improving, that tends to be a good sign for earnings improving, and then the markets as well. This is numbers from June 30th, and as I mentioned a few times over the last year, I mean, we had this high in earnings in 2019 of $165 on the S&P, and that's an aggregate number. We've had this drawdown in 2020, which I think is a throwaway year, and people aren't really focusing on. They're really focusing on the next 2 years, which is 21 and 22, and numbers have already started to move up, and it looks like we might get back to even growth at 165 versus 2019, and then see us move higher in 2022, which I think is really the key year we've been focusing on as we look at earnings and look at the aggregate and/or the individual companies. So I would not be surprised if by the end of the third quarter reporting, this 191 is probably closer to 195, and then as we head into 2021, we could even see it get closer to 200 for the year. But a lot needs to happen, and I know there's a lot of uncertainty with the markets and some of the issues with cases and the virus, and we'll talk about those in a second. So how does all this kind of correspond to our portfolios? So before I jump into kind of changes we make or how we see that, I'm going to take a pause so I can have a glass or a drink of water. But Emily, is there anything you want to add or any questions we may have?
Yeah, actually, there's a few questions, John, and I apologize, they weren't coming through to my screen, but I'm getting them now. Okay. So I'm gonna inundate you with a few. You mentioned the challenges in purchasing a new or used car, housing market, and from my experience, pool construction. How can it be such a bull market with so many unemployed? Is consumer confidence so strong, or do a lot of folks have enough money stashed away for large purchases?
Yeah, so I kind of think it's a bifurcated labor market out there, and I'll try to explain that the best I can. So we saw unemployment, I think, up to 16.8% early. I think that was the March number. maybe the April number, and that's come down quite a bit. I think unemployment rate the last time was 7.4. I think it was. It's in the 7, so 7.4, I believe. I think, you know, it's kind of the 80-20, maybe you want to look at it that way. I think 80% of the economy is doing very well. 20% is probably more, again, as I mentioned, the service end of things. So it's the retail. You know, I haven't been to the mall in 7 months. So the retail establishments, the restaurants, those areas, they're still struggling. But I think the overall economy is looking pretty good. And you know, I think as consumers, and again, consumers kind of spend their money on the overall confidence of where they think they're at, as they see their housing their housing prices go up, and they see their 401k going back to new highs. I think they're pretty confident, and some of it's just pent up demand. I mean, they may wanted to buy a car in February, but you know, all lots closed. You weren't allowed to leave your house. The economy pretty much shut down, and now it's just kind of building off that pent up demand. So, you know, I think there's certain areas of the economy we still have to help, and I think that kind of goes back to some of the issues with the stimulus and the unemployment extensions and those things. But I think the overall economy is doing pretty well.
Most of these questions are really related to something that we hear from clients quite a bit, and that is, how can the market continue to do well with so many unemployed, so many businesses closing, and you know, as you said, I guess it's bifurcated economy, but it is a question that seems to come up quite a bit in various forums.
Yeah. So, you know, that's actually, I had lunch with one of our colleagues yesterday, one of my coworkers. I won't say who, but he asked the same question. And you know, as I said, that, you know, the market's a discounting factor. It's not looking at today. And if we all sat around and we waited for the ideal time to reinvest, meaning unemployment's at a record low, the economy's growing at above trend, everybody that wants a job has a job, so to speak, it would be too late to invest in the market, because the market would have already discounted most of that stuff. So I think some of it is just that the markets tend to be a leading indicator. So as I mentioned earlier, and I said, I think we see a positive backdrop in 2021. I think that's kind of where things are focused right now. So the equity markets are focused on that 2022 earnings number, which I said is actually going up, which is a positive. So they're seeing earnings growth there, and they're focusing on, you know, the issues that I mentioned before. So I think they think there's more stimulus coming, and we can argue if you like stimulus and it's deficit spending and all those things, and I'm happy to have that conversation. But the markets tend to look at that as a positive, so they see that coming in 2021. And to be fair, if Vice President Biden wins, and polls tend to forecast that, then there's probably a bigger stimulus plan coming in the first 100 days of his administration. So I think they're looking at that. The other thing is, you know, I believe we're going to see a vaccine. How we get there, how it's distributed, all those other things, and there's a lot of issues with that, and will people take it, and all those other things, is also another path to what I would say is a return to normalcy. And I don't want to try to define what normal is anymore, because I'm not sure what that is, but I think we're going to see a path to normalcy. So I think the markets are looking forward. If you're looking at just the most recent data that comes out today, or the fact that there's almost somewhere between 7 and 8% of the population unemployed, yeah, I mean, I think I can see where people look at that and say, well, things aren't perfect. But I think, you know, what's the saying? That perfect's the enemy of good. And I think, you know, I think things are improving and they're getting better. And I think the market's looking at those issues in, you know, the next 12 months, not the last 3 weeks. So it's a hard concept sometimes to understand, but I think that's, you know, that's how it works. And as Warren Buffett would say, you want to be fearful when people are greedy, and greedy when people are fearful. So you know, the best time to invest in markets when people think it's the worst, right?
So a little bit more of a portfolio construction question. There are some segments of the economy that have lagged, like financials, way behind technology recently. Do you recommend rotating into some of those segments?
So I got a slide on our sector weightings, and I'll address that when I get that one.
Okay.
Anything else?
I think I'll hold off on the others. They're more election related, and I know you're going to cover that.
Okay. All right. I love election questions. All right. So let's move on. Portfolios. So, you know, talked about the economy, talked about the markets in general. So how does that affect our portfolios going forward, and what's kind of our thinking, our best thinking as we move into the end of 2020 and into 2021? So, you know, to be totally honest, I think, you know, small caps have been something has hurt our portfolios over really the 18 months leading up to the market low. So, you know, most of 2019 and then into the beginning of 2020. But a couple of things. One, they've actually been one of the leaders off the low in March. So they've actually either kept up or actually outpaced large cap. So I think that's a good thing, as you can kind of see this. This is the Russell 2000, which is a small cap index, versus the Russell 1000, which tends to be a large cap index. So as you can see, we've had this decline really since the middle of 18 all the way through 19, and then it kind of bottomed out as we saw the markets bottom, and we're starting to see this pick up, and we think this is going to have some legs. We'll have some back and fill in here, but we think small caps will tend to outperform, and there's some historical precedents to that. So small caps tend to do really well coming out of a bottom in the economy and into the economic recovery, which I think we're seeing today, and they're kind of falling right in line with what we'd expect. So we'd actually be a buyer in small caps, although, you know, that again, kind of going back to what we mentioned before. If you look at the last 12-month performance, you say, well, why would you be a buyer? But we're looking at the next 12 months, and we think small caps should be one of the leaders going forward. So that's something we've been keeping an eye on. As far as sectors go, and this kind of will go into the question you asked a little bit, Emily, we think sector leadership has definitely shifted towards the cyclicals. So this blue line is the cyclicals versus defensives, and I'll define that for everybody. Cyclicals are basically things that do well when the economy is improving, and that can be industrials, materials, technology, consumer discretionary, and the defensives tend to be the exact opposites of consumer staples, utilities. I'm probably missing one, real estate. So we're seeing, you know, if you see the bottom here, as the manufacturing numbers pick up, and that's, you know, that's a function of the economy, which we talked about earlier. Cyclicals have been doing better than defensive. So we don't think that's actually going to change. We think that's going to, as I said on the title, that we think cyclicals sector should lead into year end, and most likely into 2021 as well. So this is kind of our sector positioning. So kind of going back to what I just mentioned, we are overweight consumer discretionary, materials, and technology, three of the biggest cyclicals out there, and we're underweight utilities, consumer services, and staples. Again, those tend to be defensive in nature. The one I think that you mentioned or asked about is energy. So I think there's probably a possibility that, you know, you're going to see a rotation into some other sectors. I don't think that's going to change anytime soon. You know, we're kind of holding our positioning right now. We like the cyclical areas we're in, the discretionary materials, technology. If there's any areas we might lighten up on, one would be real estate. I think it's just a tough environment for real estate, especially commercial real estate. You're hearing headlines, you know, Manhattan real estate is starting to soften, which is one of the markets that has been pretty good. So we're seeing that other places as well. So real estate is probably an area we would probably stay underweight or maybe increase. Energy is an interesting one. It's maybe one of those things that's so bad it's good. You know, it's declined 2% of the S&P, which I think the lowest it's been. I guess I would want to see a catalyst, so why we'd want to change that going forward. But that is an area that, you know, we put some thought into, but I don't think we're going to make any changes anytime soon. And I think, you know, you get a little more clarity on that after the election, if indeed Vice President Biden wins the election, which it seems like he will. I think, you know, there's going to be a big push for him to be move on some of the elements of the new New Green Deal and fossil fuels and renewable energy and those type of things. So that could have a play on that sector. So as I mentioned, I think we have a tailwind going into the home stretch of 2020. I know we have an election in 3 weeks, and that, you know, that's going to add volatility. But I think as we get through that, if you look at past quarters, when we had the third quarter was above 7.5% total return, and we saw that again in 2020 at 8.5%. It's happened 12 times, and all 12 times the fourth quarter was positive, and it was positive on average by 8%. I'm not going to predict 8%, but I think it just gives you more credence that the fourth quarter most likely will be positive, and we'll build off that strength in the third quarter. So I think, you know, we can see a little more upside as we head into the fourth quarter and into the end of the year. So I went back and took a look. So as of yesterday, not counting today's market movement, we're up 3.8% so far quarter to date. So we're kind of falling in line there. I would expect a little more volatility over the next, I think it's 3 weeks till the election, but I think markets are going to start to discount that pretty soon if they haven't already. So you want to ask the questions now, or do you want me to talk? I mean, I don't have much to say about the elections other than I'm hoping it's going to be over soon.
So yeah, the one question, I mean, obviously we are getting these on a daily basis. The two things that are, you know, that are discussed more than anything else with our clients is the election and the virus. And I know you're going to cover both, but one question came through on the virus. Does the market anticipate another shutdown of our economy? Because we're starting to see that in Europe, and do you think that we'll see it here, and is the market anticipating that?
I'll touch on that in a second, but I think the answer is no, but I'll get into a little more detail there. So the presidential elections, you know, I'm just hoping it's over in 3 weeks. I think, you know, the whole issue of blue wave and contested election and all of those things, you know, I'm kind of on record that it doesn't really matter. I think long term, and we tend to be long-term investors. So, you know, the whole idea of trying to focus on the next 3 weeks and make long-term decisions on a short-term basis is kind of tough to do. But so the polls are obviously saying President or Vice President Biden is ahead. In fact, I think I saw today a poll that, take it for what it's worth, said he was up by 11% nationally. I know there were similar polls 4 years ago, so, you know, take polls from but it seems to be the momentum is definitely driving behind President or Vice President Biden. But the markets would tell you that President Trump looks good. You know, so this is a chart. If you look over the last, going back to 1928, if the markets had been up the 3 months prior to the presidential election, 20 out of 23 times the incumbent has won. If you go back to 1980, which is so really starting in 84, I think it's 9 out of 9 times if the market's been up, the president or the incumbent party wins, I should say. If the market's down, the incumbent party loses. So in this case, the incumbent party would be President Trump, and you know he would be ahead in the polls. I think it's about 6%. So that goes from August 3rd to November 3rd, would be the 3-month period to be specific. And if you go back and look, it's been about a 6% increase since August 3rd. So, you know, again, polls say Biden, markets say Trump. As I say, you know, does anything really make sense in 2020? So who knows? We'll see. And my hope is on Wednesday morning we have a winner. Kind of go along those lines. I think this is going to get a lot of play in the headlines of this blue wave. And you know, ironically, about 2 months ago, the thought of a blue wave was seen as a negative, especially for markets. Now it's starting to shift. I think, as you can see here, it's about 65% on the predicted betting site that Democrats will win the House and the Senate. I think if they win the House and the Senate, you can rest assured the president would be a Democrat as well. But you know, there's a shift away from the blue wave being a bad thing to blue wave maybe being a good thing, because the blue wave would mean that we probably won't see a contested election. I think what the market is a little concerned about is we've seen one of these drawn out elections where we don't know who the president is for several weeks. And actually I have a chart on that as well. So, you know, a contested election would be considered, you know, somewhat of a wall of worry for the markets, and I think that's something I'd like to see avoided. Most of that goes back to the fact that more and more people are voting by mail, and there's a large chunk of the vote, maybe 20%, that may not be counted until after the election or on election night. So, you know, this is a survey Strategas took of investors. I think it's about 200 people in the survey, if I'm not mistaken. And so September 25th and then October 9th, both times, only about 20% of the people that were polled thought you know who the presidential winner was on election night, which means, you know, roughly 80% think it's going to take either a week or more. You know, I think that's a concern. I wouldn't say it's a big concern, but if, you know, if we do see that point where this gets dragged out to December and we replay of the year 2000 and we have to go to the Supreme Court or the House of Representatives, that would be a negative for the markets. I don't think that's the base case. I think we're going to see a winner within that first week, if not on election night. So, you know, again, our theory is, if, you know, regardless of who wins, you want to stay invested, and history would tell you staying invested is the best key. So, not too concerned over the next couple of weeks. I think we'll get through it, and like I said at the beginning, I think we will see a presidential inauguration in January, and life will move on. So what we're watching, I'm going to jump ahead here, Emily, because this kind of goes with the virus. And the pandemic.
Can I interrupt just with one
Sure,
question one more question related to the election? It's the understanding is that Biden has talked about raising capital gains. Do you think that would have a negative impact on the market?
So Vice President Biden has said a lot of things. He's starting to clarify, and you'll see some more data put to his tax plan. I think the biggest one is for individuals. He has mentioned repeatedly that if you make less than $400,000, you wouldn't see your taxes change. So that's the vast majority of the people, of the electorate. I think the two areas where you can see some increases, one would be capital gains, and you know, they'll flush out exactly what that means, but I think that's highly possible, probable that you'll see an increase, and it's probably again on that high end of the earner spectrum. And I'm not a tax expert, so we have a lot of tax experts at Fairport, and I'm sure any one of them will be willing to have a long discussion with you on taxes if you like. But I think the answer is yes, you're probably going to see for the high wage earners some type of increase in capital gains. The other one is where I would be more concerned, I think the market is a little more concerned, is the corporate end of it, the corporate taxes. I think, again, his plan is going to be to raise corporate taxes. I'd be interested to see how fast they get raised. I think if the economy is still kind of tentative, and or we see a second wave and there's some issues there, I think they may put those out till maybe later in the first term. But so I think that's going to have, assuming he does put that out there, assuming he does get elected, it does get passed, I think that's a negative for earnings going forward, because, you know, the more they pay in earnings, the less, the more they pay in taxes, the less earnings they're going to have to share, and that slows earnings growth, and that's really what drives the market, as I mentioned earlier. So it's a concern. I'm not too concerned about it yet until we see the devil's in the details, so to speak. So we'll see how that all flushes out, and then it still has to get passed through Congress and all those other things. So it's a concern. I think it's probably net a negative. How big a negative it is on the market side, it's kind of hard to see at this point. So you asked about the virus and the shutdowns, and I don't really have a lot of input on that end of it as far as cases go. But cases are definitely climbing. I think they're climbing back to those July high numbers. But really, I think what the market tends to focus more on, and I think what would drive shutdowns of the economy, is more on the fatalities or the death side of it. And if you can see this, I think they pulled this off as of Sunday night, so it hasn't really changed much. It's a 7-day moving average, just brown or dark golden line. It's been pretty consistent. So this is that we saw a little bit of a move up, but not nearly as much as we saw as far as cases go. And it's been fairly consistent, even though cases have risen over the last month or so. I think that's a lot of things. One, it's just we know more about the virus. We know how to treat it better. We have more tools at our disposal. President Trump's a good example of that. I mean, I don't remember all of them, but he took a couple different on drugs and a couple other things. So I think we treat them better. So I think the death toll or the daily fatality is probably what's more important. And so far it's been, I don't want to make light of it, but it's been fairly well contained as far as where we're at today. As far as the shutdown, I think the bar is pretty high to shut down the economy a second time. I could see where we would be more selective on hotspots, where if there's a hotspot that breaks out in Wyoming, wherever it might be, that they might be more specific on certain areas. I think that's a possibility, but I don't think we're going to see a big shutdown. In fact, I think the World Health Organization kind of came out with something recently and has guided it, take a much more measured approach versus the overall shutdowns. And I think a lot of it has to do with mental health and all those other things that come with people being sheltered at home for a long period of time. And I think we're starting to see the fallout of some of those things. So I don't think the market anticipates a shutdown. I think if there is some type of high spike in claims, which unfortunately would result in high spike in fatalities, and the talk of a shutdown picks up, then I think that would be a concern for the markets. But so far, it's not really something that I think they've discounted going forward. Any other questions along those lines? I got one more slide, I think.
So I think thank you all there's a lot of great questions in there, but there's one that I think I'm going to try to answer, and I really appreciate it. It's, what are the plans to reoccupy your office, and have you made any decisions on your client get-togethers? So at this point in time, we have minimal staff in the office, mainly to open mail and do things that we can't do from home. Not returning at least until next year, which makes us all kind of sad. As far as client get-togethers, we have done some outdoors, very small groups, and that's obviously coming to a close as winter approaches quickly. And I think we're going to do some things virtually that we hope will make that a little bit more palatable, but we're anxious to get to the other side of this so we can all be together again. So thank you for that question.
Okay, so my last slide, and hopefully this is a good way to frame things as we move forward. As we always like to say, and this is one of the favorite slides of our colleague Andrew Connors out there. He loves this slide, so I like to throw it in there for him. But it's a time in the market is more important than timing the market. And I think again, even as we went through a decline in February, March, and we saw a bounce off of that, and then we see new highs, I think it's really important to stay focused on the long term. And this is a shorter term, and we've had other slides like this that go back further, but if you go back over the last 20 years, the S&P index has returned about 6%. If you miss the best 10 days, you'd only be up 2.4% on the annualized. If you miss the top 30 days, you'd actually be negative. I'm pretty sure over the last 12 months, really the last 9 months of the year, we probably saw one or two of the best 10 days over that period. I know we had one day where the market was up 10%. So, again, I think you want to stay focused on your long-term asset allocation, check in with your advisor, and make changes when needed when there's issues. But I think bigger picture, you want to stay invested even through market volatility like we've seen over the last 9 months. And I think that's it. We cover a lot of questions. I'll leave that up for a second, but I think we have some other upcoming events you wanted to talk about, Emily?
Sure. Thanks, John. Those of you that we didn't get to your questions, we'll have your advisors reach out directly, or the investment group. And thank you. There was a lot of great questions in there. We do have some upcoming events. One of the challenges that we're all experiencing at this time is sleep. And we've got Dr. Irina Todorov is going to talk about dietary choices and stress, and how different methods to help ease get you into better sleep. And then on Friday, November 6th, I have the pleasure of hosting with a favorite colleague, Heather Ettinger, Financial Fitness Solutions for Women. And it's a conversation about building a wealth plan for your future. So hopefully we'll see some of you at those events. We do thank you for joining us today. It's a real privilege to inspire you and your families, and we're very grateful for your ongoing trust and loyalty. Thank you, everyone. Have a great day.
Thank you.